Thank you, Duncan. So it's up to me to try to round up with a look ahead and how we're going to do in 2019 and beyond. It's interesting because, from the beginning of the year, already at the end of last year, but certainly beginning of this year, we've done quite a lot of conferences. And we're always asked, do you see shakiness in your industries and your customers? And the answer is no, we don't. And why is that? Our three key industries are oil and gas, chemicals and petrochem, and energy and utilities. They make up, as you recall, 80% of our revenue. All of these are right now very robust. They're long cycles, they're late cycles. So if something were to materialize, we would get plenty of warning, and then of course we would have to adapt and adjust. That's not the case. And if we go very briefly through our four regions, you recall that Northwest Europe on the bottom, this is mainly the activity around the North Sea. So UK on one side, Norway, Scandinavia on the other, and then Holland in the south. The northern part, continental Europe, is therefore mainly about downstream oil and gas. And here we see people investing in maintenance and field life extensions. So investments are sunk and assets are run for cash flow. We see upgrades along the European gas network, and the gas network, you follow it the same way everyone else does, is in some cases aging, in some cases being expanded. So Nord Stream comes into Lubmin, it has to go on to the rest of Germany. LNG plants are being talked about not in terms of liquefying the gas, but in regassing the liquid. So we expect in this year and next year there'll be an announcement to one of the three locations, and then again gas infrastructure comes into play to bring that imported gas into the structure. So we think oil and gas, continental Europe is mainly around infrastructure, and we're well positioned, and you saw, I think, the Fluxys project as evidence of that. In chemicals and petrochemicals, our customers are doing well. I would say ammonium fertilizer is the weak area, but all other chemicals, specialty chemicals, base chemicals, these are good business lines, and the customers are continuing to put money into their plants to drive performance and productivity. There's not so much expansion, at least in continental Europe as we know it, but people are investing their money and driving performance. Energy and utilities, Germany is interesting. You read about the coal-fired power stations that will be turned off. They produce not only electricity or energy, but also they produce hot water. So the combined heating, as it's called, then leaves consumers without a source for hot water. That's where district heating comes in. And these are projects that are well within the scope of Bilfinger, within the BET organization that we mentioned. And we're actually executing a project in Mannheim where we do exactly that. We replace the warm water from the coal-fired power station that's being shut down with a separate generation process that then delivers heating to the homes around Mannheim. I think on the far right, pharma and biopharma, I've talked a lot about. This is a good business. We're taking it to China. We're opening our office in Guangzhou to support business there. And I think you will also have read our first move into Russia, where we've sold quite a large skid towards building a new biopharma plant in Russia itself. Northwest Europe, so North Sea, this is the oil and gas part of Bilfinger. And again, we're asked often, because the people see a very strong correlation of our share price to the oil price, how much of your business is actually true oil and gas related? And it's around 15% on the upstream side, maybe another 5% downstream. So we're at 20, maybe a little bit more depending on the seasonality and on the cycles. But here definitely it's our upstream business. The North Sea is good. Customers are making money. Last year, oil and gas customers typically budgeted for an oil price of around $45 to $50. That's the same this year. These customers are not changing their plans when the price of oil moves from 65 to 55 and back to 60. They just record a high windfall profit, and I think you saw that in the numbers from Shell and BP just a few days ago. Chemicals and petrochemicals, or the downstream business, is also prevalent in Northwest Europe. This is the metropole, if you like, the chemical metropole between Antwerp and Rotterdam. That is actually the third largest chemical complex in the world. Number 1 is in China, number 2 is in Houston, number 3 is in Antwerp, Rotterdam. And you will have read that INEOS is investing there in beginning 2019, a $3 billion investment to build out a new facility there. So there are things happening even in mature markets. Hinkley Point, Duncan touched on it. I won't dwell on that. We're there. We're working there. So our people are inside the customer's organization. We're working on our project on an hourly basis, which is very nice because that's guaranteed profits. But as we go forward, we will sign the larger contract. It's going to be 250 million. It was supposed to be last year. The customer changed some structures. They asked us to be patient. They gave us a time and material contract, and somewhere this year we will sign that contract and then record a one-off lumpy order, but that will turn into revenue over successive years. So again, it gives us strength, visibility, and improving margins. If I jump to what we call the developing or international, because the other two there I just reported on were Europe. In North America, things are also good. In North America, we have a strong C component, the EMC, engineering, modifications, and construction. Our business in North America is very construction heavy, but it's constructing mainly in the midstream. And what is midstream? Oil or gas comes out of the ground at the well side. It's got to get to the refinery. So midstream is all the technology gets it there. It can be pipelines, it can be LNG, but it can also be cryo units. And a cryo unit is the refrigeration process where gas comes out. Through refrigeration, you separate the liquid component from the dry component, and that liquid component is what then goes into the crackers to create base chemicals, polyolefins, polypropylene, and so on and so forth. That is a good business. A lot of investments still yet to come in Texas, Louisiana. We were there with the press a couple of weeks ago, and people talk of a $200 billion investment, dollars, not euros, but it's probably very similar, of which only 80 have been made so far. So another 100 billion to go. We like that. Even a small part of that is a lot of money, and so we think we're in the right place at the right time. In the Middle East, oil and gas companies are picking up. The national oil companies, the NOCs, are investing again. Not only are they investing, they're making announcements. And the mentality there, they don't announce unless they intend to do it. So we've seen really good opportunity in Abu Dhabi. We've been working with ADNOC for a long time. They want to invest in the build-out of their refinery in Borouge. They talk of a number of 42 billion. What's going to be at the end of the day is something close to that, but it's going to be big. And we're already there working with ADNOC in Borouge, so we're ideally placed. They've also mentioned increasing their oil production. So, the OPEC, non-OPEC play continues. But at the end of the day, depletion, reducing pressures drives the need to replace reserves. So we're not talking about, increasing production, but merely replacing what has disappeared during the course of a year. And their aspirations have gone from, the 3 million barrels a day to 5 million barrels a day. It's another $120 billion required to do that. So money is flowing, and why? Because, again, they're making a lot of cash, even at oil prices in the range 55 to 60. I think, we're in good markets. We are in robust markets. We have, solid customers. And therefore, although we can read about recession and in other industries, we don't feel that. And we don't feel it yet, okay? And we don't feel it in 2019 either. Now, that might change, but we're confident. And that confidence, allows us to then stick our neck out just a little bit, not too far. The numbers you're familiar with right now. So in 2019, we think we can continue to grow. We've got good backlog, 12% increase in backlog year over year. We still expect to be book-to-bill greater than 1. There may be some quarters where it dips because, we're showing some very good track records. But overall, we expect mid to single-digit organic growth in 19 over 18. Our EBITDA will grow also for all the reasons you've heard. We're driving performance. We're driving productivity. We continue to take down SG&A. And therefore, we set ourselves, if you like, a baseline at 100 million EBITDA. We're going to do better than that. So a significant increase to more than 100 million EBITDA adjusted. Finally, free cash flow. It's reported now, not adjusted. We were close to break even in 2018. I'm glad we weren't in some ways because we want to put that check mark next year. But of course, free cash flow is important. It's what drives the business, and I think it's also, number one priority of Christina, as you heard during her presentation. So, we have good momentum. We see ourselves going forward, and there's no reason why we should, retract or change our aspirations that we shared with you in 2017 with the Bilfinger 2020 strategy. We said at the time, it's a long way. It's hard work, and yes, definitely is hard work. I think the whole team is nodding. Yet, we set ourselves many small successes along the way. That's important to record these successes. And in Q4, we added one more green tick mark on the adjusted free cash flow positive latest in 2018. We deliver. We haven't changed this slide to meet our results. So going forward, I think you've seen our aspirations. We're on track, and we will do that. The refinancing, that will happen very soon. And of course, the refinancing is going to be our target, our next check mark. And the cash flow development obviously helps in that regard. We did make one adjustment in our slides. Again, this is an old slide from 2017. So we said taking 17 as the base year, we would grow the top line, 5% CAGR, check mark, we're on track, good book to bill, good order intake, and a strong development in the backlog. We said that we would increase profit from a 0 effectively in 2017 to an adjusted EBITDA of roughly 5%, of which 2% or 200 bips would come out of gross margin, 300 out of SG&A. You've seen we're well on the way. But going forward, if you ask me what is my measure of success going forward, and I think Duncan's too, it's driving that gross margin now, driving it forward through all the things that we discussed, not only performance, but also the fact that we have good products with higher margins where the market is demanding those products. We have to execute, deliver on time, and then make sure those higher gross margins come all the way through to the EBITDA line. On the cash side, I think we've said enough. And sorry, I should add one more point. I said we added a line here. It's including portfolio rotation. What is that? Something we began talking about at the end of last year. And you recall my slide where I talked about the analysis. When we went deeper into companies that were, in our view, underperforming, we found improvements, we found fixes, we set timelines and actions and dates and people. But even then, they will only get as good as their peer group. We don't see them going above a 3 to 4% EBITDA. And for that reason, we said, once we've got them to what we think is a good benchmark, a peer group comparison, we will then sell them. And from the proceeds, we will buy other companies that do fit our margin profile. And that is why we did introduce here on the profit box. It's the only line, I assure you can go back to 2017 and check. It's the only line where we said we now include portfolio rotation. And that's going to be small things. It's not game changers, but we do want to spend the money we get from selling the accretive entities, the 4 that Christina mentioned, and a few other fine-tuning in our portfolio. Okay, cash we talked about, return we talked about. So I think we're on track. We showed in 2017 that we've turned around the top line. Yeah, so inflection point achieved, orders taken in, revenue taken in. In 2018, we have the inflection point on EBITDA and on cash flow. And as I mentioned, a solid backlog going to 2018. We're confident. We think we're able to deliver, and we think we will meet our 2020 ambitions. So with that, I would say thank you, pass it back to Bettina, and I guess open the floor.